Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking at three strong buy rank stocks to consider adding to your portfolio amid the current market turbulence. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three strong stocks to consider adding to your portfolio, I want to quickly do a broader market rundown just to give a better sense of what's going on with everything. So Wall Street has been selling pretty much all things remotely growth related and really most things outside of the oil and energy sector as the market prepares for higher interest rates to help combat 40-year high inflation. So at the moment, the S&P 500 is down around 15 or so percent in 2022 and down roughly 2% in the last 12 months. So was at new 52-week lows just last week, and the tech-heavy Nasdaq, meanwhile, is down about 12% in the trailing 12 months and about 25% in 2022. These substantial declines are leaving many investors wondering when buyers are finally going to start to step in on a more regular basis to stop the slide. And the uncertainty is certainly a lot to handle, with even the biggest players on Wall Street staying relatively cautious at the moment, given the unknowns. And then we saw the CPI come in still pretty hot for April, with prices up 8.3%, which was down slightly from March, but still at roughly 4-decade highs. And those prices are now pretty much all over the economy. There's really nowhere to hide. Prices are rising everywhere. With that said, though, we did see some buyers finally step in on Friday. I'm going to read you what one of our technical focused traders who runs a couple services here at Zacks. One of them is called Counterstrike. Jeremy Rowland wrote last Friday. He wrote the quote, "Everyone wanted to see some limit downs today." So this is from Friday, down days before they bought. Who can blame them with COVID panic fresh in our heads? He goes on to say, but this market is not that market. And the selling that we have seen over the last couple months will not form the same kind of bottom as 2022. He went on to say the talking heads on CNBC have been wrong all year, and a lot of them missed yesterday's level that we bought. I heard some looking for 3350, and that was for the S&P 500 support levels, which were really far below where we are at the moment. He went on to say then 3850 was the spot in the S&P, and that was the bottom. And he went on to say that's the bottom for now. We can definitely test it again. And he sort of is saying, will we? Probably not. So his sense is that the flow of money today was decidedly bullish off that technical reaction. The S&P 500 jumped. This was last Friday. Nasdaq jumped almost 3.7%. And then he goes on to say investors were too bearish and were caught off guard. For me, that is our bottom for now. I think that we see a larger move higher from here and test some fib resistance in moving averages above. With that said, it's really impossible to call a bottom besides in retrospect, but Jeremy, I trust pretty much for all things technical. So if he's saying things bounced off these levels, and I did notice that right last week on Thursday, the S&P 500 was really right on the cusp of entering a bear market, down 20% from its highs, and then it bounced back. So we'll see what goes on for now. But if you're a longer term investor, you don't necessarily need to try to time things so precisely, but you should know that these levels are pretty seemingly okay to start buying. You want a dollar cost average into it maybe, but if you're a longer term investor, don't time things greatly. Just if things are down 20%, the market's down 20%, these are going to be discounts all over the market if you're holding for years and years and even decades into the future. So with this in mind, we're going to take a look at three strong buy stocks to consider buying at the moment, even with the market being turbulent, because you don't want to be afraid to buy as you watch stocks possibly bounce up higher and higher and higher. So the first stock up on our list today is On Semiconductor, which trades in the ticker ON. The company was originally a spinoff of Motorola in the late 1990s, and it's focused mainly on growth areas within the automotive and industrial markets. On Semiconductor's intelligent power and sensing technologies support industries such as electric vehicles, connected vehicles, tech, industrial automation, sustainable energy grids, cloud infrastructure, and beyond. The company completed its purchase of GT Advanced Technologies back in November. That company is a key supplier of some crucial components that are needed to manufacture pretty much all EVs and chargers and more. So that's really crucial going forward. On is also focused on boosting its margins and continuing to exit what it considers its lower margin non-core products. So that's a good sign long term. So with this in mind, the company posted its best top line expansion since 2017 last year, with its adjusted fiscal 2021 earnings up 250% on the back of about 30% higher sales. More importantly, the company provided upbeat guidance in the face of global supply chain setbacks and chip shortages. The company then lived up to that guidance and more when it topped our Q1 earnings and revenue estimates on May 2nd. On posted record quarterly revenue with sales up 31%, driven by strong demand from those key automotive and industrial customers. And its adjusted earnings were up 250%, and it's now topped our quarterly earnings estimates by an average of 20% in the trailing 4 quarters. On also raised its guidance again and helped lift its 2022 and 2023 EPS estimates even higher to help it land a Zacks Rank #1 strong buy. As we mentioned up top, all three of these are going to be strong buys. So Zacks estimates are now calling for its earnings to soar 66% in 2022 on top of last year's massive jump. Meanwhile, its revenue is projected to climb 19% with more top and bottom line growth than expected in 2023 as well. Then in terms of some stock price movement, the stock has crushed the broader Zacks technology sector over the last 10 years. It's up about 600% over this stretch versus that tech sector's 233% climb, and it's roughly matched the larger semiconductor industry over this run as well. This includes about a 230% climb in the last 2 years off those COVID lows to blow away its semiconductor industry's 50% run. And then even more recently, On has fallen, obviously, amid most of the heavy selling to start 2022. It's down roughly 20% from its January peaks. It's currently trading at around $55 per share at the moment. And the stock's current Zacks consensus price target marks about 35% upside to those levels, so that's a great sign. And then on the valuation front, this is where the stock looks even better. On is trading at about 10.3 times forward 12-month earnings, which marks a discount to its own 5-year median, 65% value compared to its own highs, and a 25% discount compared to its highly ranked industry. In fact, On is trading right around its 2-year lows and its lowest levels since the initial COVID sell-off. And Wall Street's pretty high in the stock, with 12 of the 18 brokerage recommendations that Zacks has coming in at strong buys. And that semiconductor analog mixed industry that's a part of sits in the top 6% of over 250 Zacks industries at the moment. So On Semiconductor certainly might not be the splashiest name in the broader chip space, but it's poised to grow by supplying key components within growth markets that are really just getting started. So it certainly looks like a company to consider, and its valuation and stock price are looking pretty enticing at the moment. And now we're going to look at another company that's a Zacks Rank #1 strong buy at the moment that operates a completely separate business from On, and that is Graphic Packaging Holding Company. That's GPK is the ticker, and the company is a sustainable paper-based packaging firm. GPK shares have outpaced the market over the last 2 years and the past decade, and better yet, Graphic Packaging stock has withstood the brutal market sell-off in 2022. It even hit new highs in May following strong first quarter results. Graphic Packaging overall is a sustainable paper and fiber-based packaging firm with a portfolio of products that services companies in areas such as food, beverages, food service, personal care, household products, pets, pretty much everything you can think of. So from cereal and frozen foods to toothpaste and dog treats, if it's sold in paper-based package, there's a pretty good chance that Graphic Packaging has a sustainable solution for that. Graphic Packaging also completed its acquisition of AR Packaging back in November. The deal helped the Atlanta, Georgia-based company broaden its geographical reach because AR is one of Europe's leading packaging companies. Graphic Packaging boasts that it's now one of the biggest producers of folding cartons and paper-based food services products in both the U.S. and Europe. So that purchase could be key going forward. GPK also holds leading market positions in other areas such as solid bleached sulfate paperboard, coated unbleached craft paperboard, and some coated recycled paperboard. In general, you don't need to know exactly what that all is, but paper packaging never going out of style, especially their sustainable based offerings. People are more afraid of plastic than ever, so this could be an area that has room to grow going forward. The company also works with tons of recognizable brands, selling everything from cooking solutions and cartons and containers and cups and, as I said, just everything you can imagine. So the company's grown its revenue at a rather solid pace over the years, with just a few hiccups along the way. Its revenue climbed about 7% in 2020 and then 9% last year. And then most recently, the company topped our Q1 earnings and revenue estimates in late April. Its sales climbed 36%, obviously driven mostly by that acquisition, with organic revenue up 3%. And its adjusted quarterly earnings climbed 71%. So Graphic Packaging's 2022 and 2023 consensus earning estimates have jumped since that release. This helps it land that Zacks Rank #1 strong buy. The company is also continuing to work through the broader supply chain challenges that are impacting the entire economy. And thankfully, it's been able to adjust its prices and offset what it calls an unprecedented inflationary environment. So looking ahead, the company's revenue is projected to jump 25% this year to about $9 billion, and then climb about 2% higher than that in 2023 as those year-over-year comparisons normalize. Meanwhile, its adjusted 2022 earnings are projected to soar about 87% and then climb another nearly 11% higher next year. As we sort of mentioned at the top when talking about Graphic Packaging, its shares have outclimbed the S&P 500 pretty easily over the last 10 years, up about 375%. This run includes a 75% climb in the last 2 years versus the benchmark's 50%. And the company's also climbed about 10% in 2022, which looks really fantastic compared to the market's broader 15% decline. The company, as we mentioned, also hit new record highs in May of about $23. It was trading at around $22.71 per share were those actual highs, which is pretty impressive, seeing as that most stocks are hitting new 52-week lows during the stretch. The stock, though, has pulled back, which is pretty nice to see if you missed out on that run. It's currently trading at around $20.50 per share, and Graphic Packaging's price target or price alone of $25 or less might be attractive to some investors looking for solid low-priced stocks. And then on top of that cheap actual price tag, it's trading right at decade-long lows at 9.2 times forward 12-month earnings, which represents roughly a 50% discount to its own highs during the past 10 years and 33% value versus its own median. And this is even though the stock has gone on a really impressive run, not over the last decade, but the last couple of years as well. The company is also now trading at a 29% discount to its own industry, and investors should consider just how impressive that is with all of the things I mentioned in terms of its price and growth and its ability to outpace its industry and the market. Wall Street has clearly gravitated to the stability that the company is providing for an extended period of time, and its recent climb also comes as investors are in search of stable companies with great value, as people are in general dumping everything growth focused at the moment amid these rising interest rates. Graphic Packaging's earnings revisions activity helps it land that Zacks Rank #1 strong buy, and 8 of the dozen brokerage recommendations that Zacks has are also strong buys. And the company's paying a dividend yield, or the company's dividend yield is currently 1.5%, which is good enough to match the S&P 500. And now we're going to end with another company that's a Zacks Rank #1 strong buy that's also reported its earnings results for the first quarter, and that is Marriott International, which trades in the ticker MAR. It's a hotel titan with a portfolio of approximately 8,000 properties under roughly 30 brands across about 140 countries. So just a massive hotel giant. I'm sure you've stayed at something that was either a Marriott or owned by a Marriott, and you might not even know it. The company operates in franchises, hotels, and licenses vacation ownership resorts all around the world. Its Marriott Bonvoy is a travel program. You've probably seen a lot of ads for that recently. They've been promoting that heavily as people get back to their pre-pandemic habits. The company obviously took a big hit during the coronavirus, but yeah, people are getting back out there in living their lives again as they just start enjoying not only the summer, but just being able to travel without really that much worrying for many, many people. So recently, the company's Q1 earnings and revenue surpassed our estimates, and this was on May 4th, with sales up 81% from the year ago period. Meanwhile, its adjusted earnings were up over 1,000%. It posted 10 cents per share last year, and it posted $1.25 per share this year. And this topped our estimate by 32% for the third huge beat in the last 4 quarters. The hotel giant also saw a large surge in global travel demand. The company said that the global occupancy rose from 45% in January, which was when Omicron was more prevalent, to 64% in March, which was less than 10 percentage points below those pre-pandemic levels. And then Marriott's actual average daily room rate for March rose 5% above its 2019 levels. So that's above those pre-pandemic levels, as people are having to pay more to stay amid worker shortages and people not necessarily wanting people to clean their rooms. So there's lots of other things going on in the back end in terms of cost pressures on every company, and Marriott's no different, but they've been able to navigate these headwinds by raising prices. So if we look ahead, the company's 2022 revenue is projected to climb 43% from about 14 billion to about 20 billion. And then we're calling for another 12% growth in 2023, all the way up to about 22.2 billion, which would actually put it above its pre-pandemic totals. Finally, so this year they're going to approach those 2019 levels when the company made about 21 billion, and then next year they're projected to climb above that. So as everyone clamors back to live their normal lives. And then the bottom line, we're calling for about 87% earnings growth, and then another 22% growth in 2023. And then since that release, the company's FY 2022 and FY 2023 earnings estimates have climbed. So as they provided some solid guidance, and the company is very pleased, obviously, with its progress and its outlook, despite the rising costs and other unknowns. And we should note that Marriott in early May also announced that it's resuming its cash dividends, starting with a 30 cents per share dividend that's actually payable on June 30th to shareholders' record as of May 16th. So if you're listening to this, it's already too late to get that next dividend, but it's a great sign that they are finally now resuming that cash dividend after they paused it amid the initial COVID lockdowns, when people just didn't know what the business was going to be like in the next couple of years. And this is from their release. They said, quote, this is the CEO, I'm very pleased to share that we are resuming capital returns to shareholders sooner than anticipated. Our focus on maximizing cash flow, managing expenses, and improving our credit profile, combined with strong first quarter results, has resulted in our board declaring that 30 cents per share quarterly cash dividend payable at the end of the second quarter. He went on to say, assuming the demand environment continues to improve and that we are within our target leverage ratios, we will also expect to resume share repurchases in 2022 as well. So that's a great sign for anyone thinking about buying Marriott. They're seeing their business as stable enough to already declare their return to paying a dividend, and they might even start buying back their stock later this year. So overall, the stock is up about 390% in the last 10 years. This outpaces its industry's 250%. So that's that hotel and motels market. And then if we look over the last 2 years, the stock's up about 75%. This tops its industry's roughly 50% climb, and the S&P 500's run as well. The stock's down around 1% in 2022. It's currently trading at around $164 per share, which is about 10% beneath our current Zacks consensus price target of $180 per share. So some upside there. And then in terms of its valuation, the stock's trading at 25.7 times forward 12-month earnings, which is right around its industry's average, despite its long-term outperformance. It's traded right around in line with its industry for most of the last 10 years, if you look at this. And at 25.7 times forward earnings. It's way, way, way below where it's been over the last several years. It was during the pandemic when its earnings weren't there, but the stock was coming back. It traded as high as 78 times forward 12-month earnings. So this is back right around where it's hovered for most of the last 10 years. It's trading at levels it was last at in around the end of 2017, early 2018. And even with all those big spikes in the pandemic when it was trading at 78 times, it's now trading close to its median over the last 10 years. So it's great to see that its valuation is now coming back down and its earnings outlook looks strong. So that's why you're seeing that PE look very normal compared to where it's been for most of the last 10 years, even as the stock price rises. So the company, like all three of these stocks, is a Zacks Rank #1 strong buy at the moment. And that hotel and motels industry that it's in is in the top 30% of over 250 Zacks industries, which could be a good place to be in as people are returning to those summer travel plans. Despite rising costs, people have been proven they're willing to continue to spend even in the face of everything because they're just excited to be out there. And many households are still doing fairly well despite all of the rising prices and current headwinds affecting some people. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.